Okay, so welcome to today's session where we're going to cover the first lesson of FAC or FNAC as you call it. Today's session we're going to cover PPE and then we're going to give you a high-level overview of impairment. Impairment is a big topic, so we're not going to go into much detail, but we'll cover the basic overview of impairments. And as we do more questions, I'll give you more details regarding impairment. So the first thing is IAS 16, and then the second thing is going to be impairment. So when it comes to IAS 16, we need to understand how to classify something as IAS 16, what makes something IAS 16, or what makes something falls into IAS 16. IAS 16 deals with property, plant, and equipment, PPE. So the question would be, what makes something PPE? Then we will deal with initial recognition. Then we will deal with subsequent measurement, and then we'll deal with derecognition. So for an item to be PPE, there are certain criteria it needs to meet. So number one, it needs to be an asset. Only once something is defined as an asset and can be recognized as an asset on the statement of financial position, then we go to the next step and ask ourselves a question, what type of an asset is it? So for example, you will cover PPE, which is an asset. You will cover intangibles, which is an asset. You will cover inventory, which is an asset. You will cover leases, specifically financial, a fine, from a lessee perspective, you will have an asset that is a lease. We in the free class that I had, we had financial instruments, and under financial instruments, you had a financial asset. So it's also an asset. And then you also have investment property. So basically, there are 6 ways that that an asset can be classified. The question would be, how do you classify the particular asset? And that is what we will be discussing. So when you come across an asset, you need to ask yourself, how do you classify the asset? Now, remember, the same thing can be classified differently for different companies. So, for example, a building. For one company, a building can meet the definition of PPE. For another company, that same building can meet the definition of investment property. For another company, a building can be classified as inventory. So it all depends on the definition. So when you identify something as an asset, the next question you need to ask yourself, what type of an asset? And you'll have to look at the various asset standards that will tell you when it will fall into that standard. That is why it's important for you to make sure that you know the various asset standards you have covered. So you know in an exam that it will be one of those standards. So the question is, what makes something PPE? We said it has to be an asset. You can't have a liability and classify it as PPE. It has to be an asset. So once it's an asset, what then makes it PPE? So there are 3 basic criteria. Number 1, it must be intangible. It must be tangible, meaning you must be able to touch it, see it, feel it, so forth. Okay. So for example, a vehicle, a property, those are all tangible things. So it's one of the aspects that could make it PPE. The second aspect, in no particular order, the second aspect, it must be a non-current asset, meaning you must benefit from the asset for a period of more than 12 months. Okay, so it must be a non-current asset. You must benefit from the item for a period of more than 12 months. So it's tangible. It is it's an asset that you'll benefit from over a period of more than 12 months. And then 3, it must be used in the production of income. It must be used in the business. It must be owner occupied. So those are and another one would be, so in the third one, it's owner occupied, or it's used in the production of income, or it is leased to earn rental income. Okay, so for example, you think about Avis rents out their vehicle. I don't know if it's Avis here, but you know, like the car rental places. You go to an airport and you rent a car, Bidvest and so forth. What you would do, you'd go there and they'll rent you a car. That is PPE for them because it's an asset. It is tangible, a vehicle you can touch and see. Um, they benefit from that vehicle for a period of more than 12 months, and it is used to earn rental income. So they take the vehicle and they're earning rental income from it. And as a result, it does not meet inventory definition. It does not meet intangible definition. It does not meet investment property definition. It is so remember, with leased assets, it can be anything. So typically, a leased asset would be PPE, and it's not a financial asset because it doesn't meet the definition of financial instruments. So as you can see, that will fall into the category of IAS 16 PPE. So it's very important. Your thinking needs to be when you identify an asset, you need to ask yourself what type of an asset. Okay, so take note of that. Um, so that what makes something PPE. Now that you have PPE, now we're going to have to account for the asset in terms of PPE, in terms of the accounting standard. Now, every asset, every liability goes through a similar life cycle. You'll have an S3. You'll have initial recognition, you will have subsequent measurement, and then you will deal with derecognition. So same like a human being, they were born, they live, and then they die. So born, initial recognition, die, derecognition, and living is subsequent measurement. As you would understand, usually the most part of a person's life is living. So therefore, similarly, when it comes to assets and liabilities, most of the work will be done in subsequent measurement after initial recognition, before derecognition. So a lot of the accounting treatment will be about subsequent measurement. But let's start off with the easy stuff. Initial recognition. When do you recognize an asset or PPE for the very first time? So remember, you will recognize an asset when you obtain control. So the date that you recognize, the date that you bring the asset onto your books for the very first time is the date when you gain control. The question is, when do you gain control? You gain control when the risks and rewards of ownership transfer from the seller to you, the buyer. Okay? So typical examples would be FOB shipping point, FOB destination. FOB shipping point is when the seller loads it onto the mode of transport. FOB destination is when it arrives at the agreed destination point. Okay, so there are various types of ways ownership can transfer. Those are the typical ways. It will be fairly clear to you, but basically what you need to understand that you recognize on the date when you gain control. When do you gain control? When the risks and rewards, not only rewards, not only risks. It's risks and rewards transfer from the seller to you, the buyer. That is the date when you recognize. Now, the question is at the date you recognize, you need to put an amount to it. So, the next question at initial recognition is how much do we measure? At what amount do we recognize? So there's two questions you will answer. When to recognize and at how much. So when to recognize is when you gain control, and that is when the risk and rewards of ownership transfer. At what amount do you recognize? And that's a typical thing for most assets. The general principle is that you recognize an asset or you recognize PPE. Um, so PP is recognized based on the following principle. All costs incurred to bring an item of PPE to a place and condition ready to be used. So if you're incurring costs to bring it to a place and a condition ready to be used, That will form part of initial measurement. If the item is already in a condition and place ready to be used, and you incur costs after that point, it is no longer initial measurement. It now will fall into subsequent measurement. So it's very important. This comes through quite often. So you must be able to identify, is it a cost to bring an item to a place and condition ready to be used? If yes, it is initial, it forms part of the cost of initial measurement. The moment the item is in a place and condition ready to be used, any cost incurred after that point is no longer initial measurement. Typical things: if you buy a vehicle, the cost of the vehicle. Without paying for the vehicle, you won't have the vehicle. Then you will incur roadworthy licensing and all of those type of things. Remember, if the car is only technically ready to be used, if it's licensed, if it's roadworthy, and all of those type of stuff. So those costs is a cost incurred to bring the vehicle to a place and condition ready to be used. Because remember, legally, you need the car to be roadworthy, and need the car to be licensed, and so forth. So basically, it is a cost you have to incur to ensure the car is roadworthy. Okay, so just take note of that. Similarly, if you import something without incurring import duties, without incurring custom duties, without incurring the transport costs from that is incurred from transporting from the foreign country to wherever you need to be, you won't those costs. If you don't incur it, you won't get the item to a place and condition ready to be used. As a result, that forms part of initial measurement. Some items is quite sophisticated, so it needs specific people to install it. So as a result, without the installation cost, the thing is not in a place and condition ready to be used. It's very different from a computer and a TV. For a computer and a TV, just simple plug-ins. Anybody can do it. So that is there's so you don't need so any the installation is not a significant component. Okay, so just take note of that. Then you must take what is very important. You may incur costs that gets refunded. Okay, so for example, I'm not sure how that works in Zimbabwe, but in South Africa and in most parts of the world, so I'm assuming in Zimbabwe as well, we incur VAT. Okay, so um, if you a VAT vendor, and you, so for example, here in South Africa, we have, let's say, Pick and Pay, and we have Coca-Cola. So when Pick and Pay buys from Coca-Cola, included in that price that Coca-Cola sells to Pick and Pay, they pay VAT. There's a VAT component in that price. But because Pick and Pay is a VAT vendor, Pick and Pay can claim back the VAT they paid to Coca-Cola from the South African Revenue Services, the tax authorities here of South Africa. So as a result, even though they paid an amount of VAT, they will be able to claim back that VAT. So in terms of accounting standards, in terms of IAS 16, you will not include VAT in your cost of your PPE because it's not a cost incurred. You can claim it back. So you must just pay very careful attention to those type of things. So that is initial recognition. At initial recognition, there are two questions you need to answer: when to recognize and at how much. So when do you recognize? When you gain control. You gain control when the risk and the rewards of ownership transfer from the seller to you, the buyer. At how much do you recognize? So what is initial measurement? All costs incurred to bring an item of PPE to a place and condition ready to be used. Okay, so just take note of that. That is basically the aspects regarding initial recognition. Now let's go to the other end, derecognition. Derecognition, like initial recognition, like recognition is bringing an item onto the books. Derecognition is taking an item off the books. So the typical way of taking an item off the books, derecognizing PPE, is when you sell PPE or when you depreciate it up until it is zero. Okay, so you depreciate it over its entire useful life and it is zero. So one way you sell. Another way, it is fully depreciated. And a third way is when you write it off, when you impair it, when you write it off to zero. Okay, so that is how you de-recognize an item of PPE. Okay, so initial recognition, two things: when to recognize and at how much. De-recognition is just simply the aspect of um, the issue of taking an item of PPE off the books. There are three ways it happens, or typically there are three, there may be more, but typically the three ways it happens is when you sell PPE, when you depreciate it up until it is zero, or when you write it down to zero. Okay, when you have a complete write-off and impairment when it is zero. A complete write-off or impairment is basically a vehicle in an accident, a factory burnt out, goods are completely obsolete, things like that. Okay, so then there's no longer future economic benefit. You expected future economic benefit, but because of this event, something there's no longer a future economic benefit. So therefore, you have to write down the asset to zero. That's an impairment. So that is one way to de-recognize. Similarly, you're just using the asset as you expected up until the asset is fully used. That is also de-recognition. And then, but the one that makes sense to us is when you sell it, you're physically selling the asset. Okay, so that is a form of de-recognition. Now we come to the middle aspect, subsequent measurement. And this is where most of the things take place. So there are various aspects that we deal with under subsequent measurement. One aspect would be um, subsequent expenditure. Okay, the word subsequent expenditure. I'll explain this in detail just now. Then it is, how do you measure the asset after initial recognition? So how do you measure the asset after initial recognition? So remember, at initial recognition, how do we measure it? All costs incurred to bring an item of PPE to a place and condition ready to be used. How do we measure it after initial recognition? So how do we measure it in subsequent measurement? We deal with two measurement models. We have the cost model and we have the revaluation model. Under the cost model and the revaluation model, there are various aspects where we have to look at. It is depreciation and useful lives, and then also impairment. So those are the big items under subsequent measurement. Subsequent expenditure, measurement models, which is a revaluation and cost model, depreciation, useful lives, and impairment. Okay, so what you must understand, impairment is very basic in IAS 16 because there's a separate standard dealing with impairment. The standard that deals with impairment is known as IAS 36. So IAS 16 does not have all the details of impairment. You must go to IAS 36 to look at the details relating to impairment. So let's talk about subsequent expenditure. Subsequent expenditure relates to the following. Subsequent expenditure relates to cost incurred after initial recognition. Remember earlier, just a few moments ago, I said that um, initial measurement is all costs incurred to bring an item to a place and condition ready to be used. The moment you incur a cost that is after the point when the item is ready in a condition and place ready to be used, that will be, there's no longer initial cost. It no longer forms part of initial measurement. It now falls into subsequent expenditure. The two big questions when it comes to subsequent expenditure is to how to treat subsequent expenditure. There are two big questions. Do I capitalize it, meaning do I add it to the asset, or do I expense it? So when you incur subsequent expenditure, it is expenditure that is incurred after the item of PPE is in a place and condition ready to be used, now in subsequent expenditure. The big question is, do we capitalize or do we expense? Capitalize means you add it to the asset, you increase the cost of the asset. So the basic rule is if the subsequent expenditure increases the economic benefits of the asset. If the subsequent expenditure increase the economic benefits of the asset, you capitalize it. So for example, it increase the useful life or it increase the value, then it would be considered then it is it increasing economic benefits. As a result, you will capitalize it. If it does not increase economic benefits, it's simply just restoring the asset, then you will expense. The standard makes it clear when it is anything of maintenance or repairs, and you do maintenance every 12 months, whatever, if it's maintenance and repairs, you expense. So whenever you see maintenance and repairs, you expense. The standard says maintenance and repairs does not increase the economic useful life. It is just restoring the asset so that you can use it for its useful life. As a result, you will expense. But any other thing that is significantly improving the useful life and so forth, you will you will capitalize. Okay, so that is subsequent expenditure. So the first thing you need to identify what makes something subsequent expenditure. Once you identified what makes something subsequent expenditure, and if it is subsequent expenditure, the question you need to answer is whether you capitalize this cost or whether you expense it. If it's repairs and maintenance, you expense. For other stuff, you need to ask yourself, is it increasing the the future economic benefits? If it is increasing the future economic benefits, you capitalize. If it is not increasing the future economic benefits, you expense. Next, we come to the measurement models. Under the measurement models, it's simply a question of what is the accounting policy of the company? Are they using the cost model or are they using the revaluation model? A company can choose which one they want to use, and they might just use it consistently for the same class of assets. So for example, if they choose vehicle to be cost, all vehicles is cost. If they choose for equipment to be at the revaluation model, all equipment must be at the revaluation model. Okay, so it might just be, they must use it consistently for a class of assets. Now, for our purposes, the cost model will be used for depreciable assets only. The revaluation model, the cost model, what was I saying? So the cost model, the revaluation model, in the accounting standard, you can use the cost model and the revaluation model for any PPE asset, your choice. But I know from a CICA point of view, right? So CICA that looks after the CA programs from the universities and so forth, what is examinable is that they only have revaluation model for non-depreciable assets like land, and then for all depreciable assets, we have the cost model. Because in the real world, companies hardly use the revaluation model for depreciable assets. It's just too complicated. So the cost benefit is just not worth it. So most companies don't use the revaluation model for depreciable assets. And that is why CICA, I think about 3 or 4 years ago, took it out of the syllabus. Okay. And I think when I was reading through that document that Tao sent me, I also saw it wasn't in part of your guys' thing. So revaluation will only apply to land for our purposes, and then cost model will apply for any PPE asset. Okay. So that is the measurement model. A company can choose, once they choose, they might just make sure it is consistent for the different classes of PPE. When we use the word class, machinery is a class, buildings is a class, land is a class, vehicles is a class, equipment is a class. All of them are PPE, but each of them are classes of PPE. So measurement model, depreciation, all of those type of things will be relative to a class of assets. Okay, so just take note of that. So we covered subsequent expenditure, we covered measurement model. Now we come to depreciation. There are three methods of depreciation. We have the straight line method, this is the most common one. Then we have the diminishing balance method, and then we also have the the units of production. Okay, so the company will choose based on how they perceive they will benefit from the item. Okay, don't have to worry too much about it. We will go through how to calculate as we work through questions. But basically, the three models, um, straight line method, diminishing balance method, and the units of production method. The important principle when it comes to depreciation, you start to depreciate when the item is ready and available for use. Once the item is ready and available for use, that is when you start depreciating. Not when you buy it, not when you actually start to use it, but when it is available for use. Sometimes when you buy an asset, it's not yet available for use. Sometimes you use the asset in the 1st of December, but it was already available for use the 1st of November. So when do you start depreciating? When the item, when the asset is available for use. Very, very important. Okay, that is depreciation. Useful lives is basically how long you will be using the asset. Once again, this is judgment. A company will decide this. Every single year, the company must assess the useful lives. Every single year, the company must assess the residual value because both items, a useful life and a residual value, are estimates. So that's why every year they have to assess whether the estimates are still appropriate. So just take note of that. Okay. Then lastly, we come to impairment. The big part of impairment is dealt with in IAS 636. We're going to cover just basically here. And then as you do more complex questions, I'll share with you more regarding impairment. The big principle when it comes to an asset is that an asset cannot be recognized on the balance sheet at an amount more than the future economic benefits. So when you look at a balance sheet, when you look at a statement of financial position and you see an asset, basically the company is telling you that that amount that you see for that asset, that is the economic benefits we expect in the future. So as a result, the amount that you show for an asset on the balance sheet must not be an amount that is more than the future economic benefits. So typically, the amount that is recognized is a carrying amount based on an accounting standard. So for PPE, it will be costs less depreciation, or it will be revaluation less depreciation. Okay, so that is what it shows over there. But if that amount, that carrying amount, which is cost or revaluation less accumulated depreciation, if that amount is more than the future economic benefits, we can't recognize that amount because the principle is assets must not exceed the future economic benefits. It must be equal to or less. Okay. So the moment your carrying amount, which is cost or revaluation less accumulated depreciation, the moment that amount, which is carrying amount, is more than your future economic benefits, we will have to impair the asset. So how do we go about impairment? When you look at impairment, you only have to what we call it now. You only have to test for impairment when there is an indication of impairment. So if there is an indication of impairment, only then do you have to test for impairment. Every year, you will have to assess whether there are any indications. If there is no indication, no need to do the impairment test. If there is an indication of impairment, then you must run an impairment test. So basically, there are two types of indicators. The standard deals with internal indicators and external indicators. So for example, the financial crisis, COVID, those are external indicators, or a competitor coming into the market. That is an external indicator. Okay. An internal indicator is when you're losing market share, your product is becoming outdated, things like that. The machines are breaking down. Those are internal indicators, but not affected by the general economy or the industry and so forth. Okay. So if there is an indication of impairment, then you run the impairment test. The impairment test is as follows: carrying amount compared to recoverable amount. Now, carrying amount, like we said, costs less accumulated depreciation, or revaluation less accumulated depreciation. That is your carrying amount. Now, the carrying amount is the amount that is generally on the balance sheet. Now, you compare this carrying amount to the recoverable amount. You only do this impairment test comparing carrying amount to recoverable amount if there's an indication of impairment. So now we compare. So as you can see, carrying amount compared to recoverable amount. We know what is carrying amount. The question is, what is recoverable amount? Recoverable amount is the higher of value in use and fair value less cost to sell. So recoverable amount is one of two amounts. It is the fair value that you can sell the item for, less any cost incurred to make the sale. That is fair value less cost to sell. It is the amount that you can sell it for after you have incurred necessary costs. Okay. Value in use is where you do a valuation to work out what is the value of using the asset. So, for example, you can use the asset to produce coke. So you will work out how much coke can you produce, how much and how much you can sell it for. So basically, doing like a mini valuation, that is value in use. So you must be able to determine value in use. You must be able to determine fair value less cost to sell. That is the two amounts that a recoverable amount can be. The recoverable amount is the higher of the two. That is why we must do both calculations and we choose the one that is the higher. If the recoverable amount is more than carrying amount, then there's no need to worry because it is less than future economic benefits. But if the recoverable amount is less than the carrying amount, then we have to impair the asset. So that is basically a high-level overview of PPE with impairment. Impairment is a lot more complex, but we will get into the complexities as we do a question. Okay. I'm gonna stop there for the high level overview. We'll go into the question now. I'm gonna see if I can save it now. While I try to save it, just think, is there any question that you'd like to ask me before we dive into the question?
FIS,
Yes.
sorry to take you back a little bit, but on the last part where you were talking about recoverable amount,
Yes.
would you mind another shot or you look at it again during the question?
Yeah, we're gonna cover it now.
All right.
Any other questions?
Um, Faiz?
Yes.
Yes, I just wanted to confirm, let's say we probably stop using an asset.
I
After
can't hear you so clearly.
you can hear.
Speak a bit.
Can you hear me now?
Yeah.
Hello?
Yes,
Can
I
you
can
hear me
hear.
now?
Yes.
All right. So I was saying, let's say we have recognized an asset on initial recognition, then probably a few years down the line we stop using it for whatever reason. Then maybe we then resume using it probably after some period. So within that period that we are not using, should we continue depreciating it or we also stop depreciating?
The question would be is why did you stop using it? If you stopped using it, is it because um, you're using another asset? If you're using another asset, why did you decide to use another asset? So it may be a reason that may be an internal indicator of impairment. So then you will most likely have to impair the asset. Because why did you stop using it? Is it because that item no longer is used because is no people do not the product that that item can make is no longer um, useful to the market, things like that. So we have to assess what is the reason of not using it. Um, that will generally that is an indication of impairment, and as a result, we'll have to do an impairment test. But if it doesn't meet the impairment, we'll just continue depreciating until the end of its useful life. But it's going to be, yeah, that's what you almost will have to do.
All
Does
right.
that answer your
Thank you very
question?
much. Yes, thank you very much.
I'm just quickly sending you guys the question, then you can read this very quick, and then we'll go through it.
Fires, then a quick one. So there is something that we went through in Zimbabwe in February 2019, where we translated, I think the term is translated, we're translating our assets values using the interbank rate. So we used to recognize our assets 1:1, which was the USD amount. Then come February 29, we translated the values using the interbank rate, which was that time 2.5. So which means all our assets were multiplied with that 2.5 to to recognize the values at that a new amount. So what is basically the difference between the translation and the revaluation?
Are you doing it for foreign currency now? Can you hear me?
Yes, I can hear you.
So you're talking about foreign currency. So you saying, let me just see if I got your question, if I understand what the scenario you just presented. So you are in Zimbabwe, you acquire an asset or whatever it is in USD.
Mm-hmm. Yes.
Okay, and then so on the
February 2019, we kind of translated the values to the interbank rate. So that means our assets were moving from the USD to the ZWL.
Okay, yeah, to the Zim rate, right? Okay. So basically you went from USD to the Zim dollar, if I can put it that way.
Mm-hmm, mm-hmm.
And then,
Yes, yes.
okay, and then?
So that was the translation.
Yeah.
So I'm asking, so there is a significant difference between the translation and the revaluation, right?
Yeah, so when you say revaluation, you're talking about the revaluation we just dealt with now.
Yes.
Yeah, no, it's two separate things, yes. So revaluation, just basically, a revaluation is similar to a fair value. So, for example, if you remember from financial instruments, you can buy shares at, like, I'm going to use ZAR quickly, South African Rand. I can buy shares at 10 Rand, but at the end of the year, the shares went up to 15 Rand. So that is a revaluation. That is a fair value, going from 10 to 15 Rand. What you are doing, that is a translation of foreign currency. That's nothing to do with revaluations. Okay. So revaluation is just basically the market value of the underlying item. It's got nothing to do with translation. So if I give you an example with translation, so let's say, let's use the Zimbabwe thing. So perhaps you made an investment in Tesla. Tesla is based in USD, right? So let's say, I'm gonna make it just simple. You bought for $100 the beginning of the year. The end of the year, when you do your books, Tesla is no longer $100, it is $200. So that $100, that is from 100 to 200, which is $100 increase. That is the revaluation. That is the fair value adjustment. But then you also have another adjustment, which is converting that. It is converting that $200 into whatever the equivalent of a Zim dollar is. That is the translation aspect. Now, maybe what you are confusing, because I know what you call it, is when there is this foreign currency and a fair value, they don't distinguish. The accounting standard says when you do a fair value adjustment, and it involves foreign currency, they don't separate the foreign currency from the fair value adjustment, which is just too complex. So it's too much time to say what resulted from the fair value adjustment and what resulted from a translation adjustment. So what we just do, we just translate using like the example you gave, without separating what is actually a foreign currency translation and what is actually a revaluation. Now the two are completely separate though, but in that instance we don't do the separation, just too complex. So that I don't know if that will answer your question basically.
Yes, it is. Thanks, Vice.
Okay. I sent the question in the group. Just tell me if you got it. My side it's sent. My side it is sent. So if you can just spend 5 minutes reading it, and then I will read it with you guys. Okay. And then we're going to tackle it together. Okay, you guys are ready to go through it? Okay, so it reads as follows. Let me just see. I think this is one page. Yeah. So they say Quavo Ltd has a business that manufactures and sells compact disc CDs of the performances of famous artists in Wakanda. So there you can see what do they do. They manufacture and sell. So they manufacture CDs and then they sell it. The artists, I'm sorry, the assets used in the business qualify as a CGU. The carrying amounts of the assets in the CGU as of 31 December 2019 are as follows. Okay, so just understand in IAS 36, which is impairment, they talk about an aspect called, or they talk about a concept called CGU, cash generating unit. The general principle is that you must impair a single asset. Okay, so you have to impair a single asset. However, some assets can't generate cash flow on its own. As a result, you can't impair that asset. You'll have to then include that asset in a CGU. What is a CGU? A CGU is the smallest group of assets that can generate cash flows independently. So for example, um, for example, the machinery that Coca-Cola uses to sell Coke, the machines on its own cannot generate cash flows independently. How do the machines generate cash flows? By producing Coke, and then the Coke must then be with other, so the machines are used with other things like powders, gas, whatever, to make Coke. Once the Coke is made, it must then be bottled. Once it is bottled, it needs to be sold. So there's lots of aspects that gets the Coke to be sold. It's not the machine on its own. As a result, the machines of the machinery or the equipment that Coke uses to manufacture Coke cannot generate cash flows on its own, cannot generate cash flows independently. As a result, it will form part of it will form part of other assets that can generate cash flows together on their own. That is different to a car rental. The car rental, they can argue that each car can generate cash flows on its own because simply the car itself is being rented out and generating money. So you might just think about what separates a cash generating unit from a single asset. So the way you think about it is as follows. You must always start on the smallest, on the lowest level. So the lowest level is looking at it from an individual asset. In most cases, an individual asset, an asset on its own cannot generate cash flows on its own, cannot generate cash flows independently. As a result, you must go to the next level, which is to look at the next smallest combination of assets and liabilities that can generate cash flows independently and so forth. So there's going to be a typical concept over here. So as you can see, they are talking about this business that manufactures and sells compact discs. And they're telling you the assets used in the business qualify as a CGU. So they are trying to tell you all these assets, equipment, machinery, furniture, and goodwill, those four assets, they form a CGU, meaning those assets is the smallest group of assets and liabilities that can generate cash flows independently. So it's very important on this level. You're going to get you always going to be tested on CGUs because that is the real way IS 36 work. That's the real way that impairment works. In first year and second year, and most likely even third year, they don't deal with CGUs because it's a little bit complex. We always dealt with impairment on an individual asset level because it was just assumed that every asset on its own can generate cash flows independently. Now, when you're in honors year, you deal with impairment in its true sense. You deal with impairment in terms of IAS 36, which says, yes, you would IAS 36 wants to impair individual assets, but the principle is that you can only impair an individual asset if it can generate cash flows on its own, if it can generate cash flows independently. And like I said, most assets cannot generate cash flows independently. As a result, we need to include assets and together with liabilities in a CGU. The definition of a CGU is the smallest group of assets, smallest group. Because remember, ultimately you want to get to an individual. So that is why, because an individual don't work, the next level is the smallest combination, the smallest group of assets that can generate cash flows independently. Independently just means that they can generate cash flows on their own. So that is why they're indirectly telling you that the equipment can't generate cash flows on its own. The machinery can't generate cash flows on its own. The furniture can't generate cash flows on its own. But all of them together, when they work in a combination, when they are grouped together, then they can generate cash flows on their own. So that is what a CGU is about. And if you understand what goodwill is, you can understand goodwill cannot generate cash flows on its own, because goodwill is as a result of a business. So therefore, it is that business that would have goodwill. So goodwill can never generate cash flows on its own. So let's go. They have equipment, $30,000, machinery, $28,000, furniture, $42,000, and goodwill, $25,000. So therefore, the carrying amount of the CGU is 125. Now they're saying the following information regarding the recoverable amount of the CGU is as follows. Fair value less cost to sell, and then value in use. So they're giving you the fair value less cost to sell, they're giving you the value in use, $70,000 and $82,000 respectively. Remember, one of those two amounts is the recoverable amount. Which one? The recoverable amount is the higher amount. So which one is the higher amount? The higher amount is the value in use, because that is $82,000. So therefore, the recoverable amount is the value in use amount of $82,000. Now we say, okay, carrying amount versus recoverable amount. Carrying amount 125, recoverable amount 82. Remember, the carrying amount should not exceed the recoverable amount. So the carrying amount is exceeding the recoverable amount. So therefore, we will have an impairment. Okay, so let's go on. The only fair value less cost, the only fair value less cost of disposal available for individual assets is for furniture, for which there is an active market. The fair value less cost of disposal amounts to 38,000 Rand. So now they say prepare all the journal entries. So let me show you how we will deal with this. I'm going to open up Excel. So it'll take some time. A piece a bit slow today. Well, often. I'm going to open up Excel and then I'm going to show you how we will deal with this. You can ask me questions as we go along. We just start it and then you can see how we will deal with it. Okay, I'm busy opening up Excel. Okay, I'm going to share my screen and I'll tell you when you should be able to see Excel. Okay, you should be able to see Excel. Just tell me if you don't. Okay, so let's deal with this question. This is how you will go. Remember, we need to do journal entries. Okay, but let's just show you how you'll go about doing the journal entries. So we can assume there's an indication of impairment because they're giving us some information. So we have to do the impairment test. Okay. The impairment test is to compare recoverable amount versus to compare the carrying amount against the recoverable amount. So when we do an impairment test, we compare the carrying amount to a recoverable amount, either an individual asset if the individual asset can generate cash flows on its own. Like we said, most assets cannot generate cash flows on its own, so they will form part of the smallest group of assets that can generate cash flows on their own. So in this case, in this scenario, the equipment can't generate cash flows on its own. The furniture, the machinery, none of it can generate cash flows on its own. As a result, they form a CGU that can now generate cash flows as a group of assets. Okay, so it was equipment, it was, what was it now? Machinery, furniture, machinery, furniture, and goodwill. So this forms the carrying amount of the CGU. So this is the carrying amount of the CGU. Okay, so this is the carrying amount of the CGU. So the amounts is 30, 28, 42, 25. 30, 28, what was it now? 42 and 25. Okay, so this adds up to the carrying amount of the CGU, which is the 125. Okay. Now we know we're doing an impairment test, so we have to compare to the recoverable amount. So now we're going to say recoverable amount. So the recoverable amount, recoverable amount. So remember the recoverable amount. What is the recoverable amount? It is the higher of value in use less cost to sell. Okay, so higher of what? Fair value less disposal costs and disposal costs and what was the other one? Value in use. Value in use. Okay. So the recoverable amount is the higher of what was the value in use? 70,000. I mean, the fair value was 70,000. Value in use was 82,000. So therefore, the recoverable amount is how much? It is the $82,000. Okay, so now we're saying compare carrying amount to recoverable amount. Remember the principle is the carrying amount cannot exceed the recoverable amount. In this case, the carrying amount is exceeding the recoverable amount. As a result, there will be an impairment. So what is the impairment? The difference between the two. If the carrying amount was not more than the recoverable amount, then there is no impairment. So therefore there is an impairment. The impairment is the difference between the two. So the impairment is the difference between the two. The question must be now, how do we do this impairment? The journal entry, they want journal entries, right? So the journal entries will take place at the end of the year. When is this? 31 December 2019. So the journal entry will be as follows. 31 December 2019. We're simply going to have debit, credit. So let's remove this. So we're simply going to have impairment. Impairment always goes through P&L. We know what the impairment is. It's most likely going to be 43,000. I can't put the amount in yet because we have to do some further testing. So that we're going to say debit impairment loss, most likely 43,000. We'll have to do a further testing just now. Then for every debit, there must be a credit. The credit will go against these assets over here. What you must understand, when there is goodwill, the impairment first goes against all the goodwill. So as you can see, the impairment is 43,000. How much is the goodwill? The goodwill is 25,000. So the impairment will be written against goodwill to the max. But goodwill only accounts for 25,000. So what is left over? 43 minus 25 will give you, let me just see, 43 minus 25, so it's 18,000. That 18,000 we will split between these three assets. So remember, whenever there's an impairment and whenever the CGU has goodwill, you first write off the impairment against goodwill as far as possible. If the goodwill, like in this case, goodwill is 25,000, let's say impairment was 20,000, then the full impairment goes against goodwill. Okay, because goodwill 25, impairment is 20, so the full 20 goes against goodwill. There will still be 5,000 Rand left over of goodwill. In this scenario, the impairment exceeds goodwill. So we write off the impairment as far as there is goodwill, which is 25,000. But there's now still 18,000 Rand left over. That 18,000 Rand will be split between the remaining assets. So that 18,000 will be split between the remaining assets. So just take note of that. So we will most likely bring in these assets now: accumulated depreciation, equipment. Then we're going to have accumulated depreciation for the others as well. The next one is machinery. And the last one is, what's the last one? Furniture. Okay, remember you also want to call this accumulated depreciation or accumulated impairment. Accumulated impairment goodwill. Okay, so remember that the rule is if there's goodwill, you write off all impairment against goodwill first. Anything left over is split between the other PPE assets.
IFRS.
Yes.
I didn't get where you said when the impairment loss is not exceeding goodwill, what will be the treatment there?
So if the impairment is 20,000 Rand, that means the full 20,000 Rand will just go against goodwill. So we say debit impairment, credit, accumulated impairment, goodwill, 20,000 Rand. You won't take it against any other asset because the full amount first goes against goodwill. That is the rule. Impairment is first written against goodwill. So if the full amount goes against goodwill only, you're only taking payment. You would only have debit impairment loss, credit accumulated impairment, goodwill. Whereas in this scenario, there's more than goodwill. So the amount that is left over, as you can see, 18,000 is left over. We first written off against goodwill of 25,000. So what is left over of impairment? 18,000. That 18,000 will be split between these three assets. Does that make sense?
Yes, yes, it does. Um, just shed some more light, Fires, on the goodwill impairment.
Yeah.
So the company is acknowledging that we no longer have goodwill.
Yes.
Okay.
With accounting standard once, that's what the rules, if you read IAS 36, that is the rule of IAS 36. You first write off any impairment against goodwill if there's goodwill. And it makes sense why, kind of makes sense why. Because remember, if you remember group accounting, goodwill arises on when a parent acquires a subsidiary and where the parent pays more for the subsidiary, what the subsidiary's carrying values is worth, okay, or what the subsidiary is worth. So let's say the subsidiary is worth a million rand, but the parent paid 1.1 million. So therefore, the extra 100,000 is considered goodwill. So now remember, goodwill can be easily manipulated in any direction, easily manipulated by companies. So and in many cases, companies overpay for an acquisition and they get huge goodwill balances. And as a result, when you have a CGU that includes goodwill and there's an impairment, accounting standards are saying it is most likely the goodwill that is overstated. Therefore, any impairment must first be written off against goodwill, and you will slowly eliminate any overstatement of goodwill. So that is basically like what I think the rationale is. Was that's what the accounting standards are saying. You first write off against goodwill because remember this. What is goodwill? Goodwill is only the amount, the excess amount above what you paid. So you paid 1.1, you bought for 1 million. So that is an excess amount. How do you get to that? Lots of judgment. If you must read the accounting standards carefully, there's lots of judgment involved. And in many cases in the real world, like for example, here in South Africa, Vodacom, when they acquired, I think 3G at that time or 4G, whatever it was, some time ago, they overpaid, and they had a huge goodwill balance. And then not long afterwards, it was crystal clear that they overpaid. So what did they have to do? Impair massive goodwill balances. And so that is the reasoning that the standard, whenever there's goodwill in a CGU, first write off an impairment against goodwill before you write off against other assets. So that is basically what we're doing. So in this case, we have 43 million or 43,000 impairment. First, write off against goodwill. Goodwill is only 25. So therefore, we're writing off goodwill to zero. There's no more goodwill in this company or in the CGU. And then if any other thing, we will write off against other assets. Another important aspect to understand, there is a concept known as a reversal of impairment. So over here, we're having an impairment. We're going to write off 18, we're writing off an impairment of 43,000. 25,000 is going against goodwill and 18,000 is going to be split between these three assets. A reversal of an impairment cannot take place against goodwill. Once you write off goodwill, you can never reverse that impairment. Whereas if you have an impairment against any other asset, the accounting standards allow for a reversal. But I don't think a reversal is part of your syllabus. I never saw it when I was looking in that document that Taurai sent me. So let's just deal with
All
that
right.
quickly.
Thank you very much, Fires. I think I now have a better understanding of what will be happening with the goodwill issue. So yeah, thank you.
So remember, we know this in the most likely 2043. I can basically put in the 43 over here. But when we do further tests, that impairment may end up being less. So I don't like to bring in that amount immediately, but because it seems a simple example, I doubt it's going to be less. So I'm just putting in the 43 over here. But as you do further analysis then the 43 may change. But like I'm saying, our impairment is 43 based on our initial test. RF43, we first write off against goodwill. This journal is not balanced. This journal is not balanced. Every journal must balance. We know the difference is we know the difference is 18,000. So that 18,000 must be split between these items over here. But to know how much to take between the various items, as the equipment, machinery, and furniture, we need to do some further analysis. So that's what I'm going to do now. So remember, when you have an impairment and there's goodwill, you first write off against goodwill, then against the remaining assets that fall within IAS 36. All of these are of PPE, equipment, machinery, furniture. They are all PPE. PPE falls within the scope of IAS 36. That is why we're going to write off against all of them. However, if there was an asset that did not fall within the scope of IAS 36, so for example, inventory does not fall into the scope of IAS 36, you won't write off against inventory. But we will deal with that when we come across a question. I just wanted to bring it to your attention. So all three assets are PPE. PPE is within the scope of the impairment standard IAS 36. Therefore, we will write off against the remain. We'll write off against those assets. Okay, so against goodwill. Okay, so remaining impairment. So that remaining impairment we will split now between these assets. So we'll bring in these assets. So remaining, so that's carrying amount. Just so you know, carrying amount before impairment. Okay. Then we will have impairment allocation. And we will have carrying amount after allocation. So let's have a look. So the way we're going to do, you just basically do a weighted. So if we add this up, so we bring in all of the remaining assets. Why? Because of the fact that they all fall within IAS 36. I mean, they all fall within, they're all PPE, and all PPE assets are within the scope of IAS 36. So we can apply the allocation to all of those. So how do we do it? We say 30,000 divided by 100,000. You can see we excluded goodwill, multiplied by the remaining impairment, not the 43,000, but the 18,000. So if I run that across, that is what the impairment allocation is. If I add it up, it must add up to the 18,000. Okay, so technically we will bring in these amounts over here. But before we can do that, we need to do a check. So we're going to say, okay, that carrying amount before impairment minus the impairment allocation will give me a carrying amount after the impairment. But we'll have to compare to the recoverable amounts. Okay, so we have to compare to the recoverable amount. Okay, so if we have a look, they told us in the scenario, remember below that table, in the last paragraph above the required in the scenario, they said the only fair value less cost of disposal available for individual assets is for furniture for which there is an active market. The fair value less cost of disposal amounts to 38,000. So here is an amount for this asset of 38,000. Okay, so here is an amount of 38,000. There's nothing for the others, so we don't need to do anything about the others. So what you can see, the amount, the carrying amount after impairment, the carrying amount after impairment cannot be less than this recoverable amount if there is a recoverable amount available. So you can see we can get 38,000 Rand for this, $38,000 for this furniture. But after the impairment, it is 34,400. So as a result, we can't write off this asset by 5.7, by 7.5, we have to reduce it. So the way you just reduce it, we will just have the following. So as you can see, what we will do, it is simply going to be a situation of we have to reduce that impairment by that. So this impairment will be its initial allocation plus a reallocation. So we call this a reallocation. And this is going to be your final impairment. So what you can see that under the initial impairment, allocation, we're allocating 7,560 Rand to furniture. When we allocate 7,560 dollars to furniture, the carrying amount after the impairment allocation is $34,400. But like we said, the recoverable amount of that asset is more than what we are stating over here. So what we would have to do, we will have to do a reallocation. We can't write off the asset by 7.5. It has to be less. So we have to limit the write down to $38,000. As a result, we have to reduce this impairment of 7.5 by 3.5, which gives us a final impairment of $4,000. And the remaining, we will have to split this 3.5 between these assets over here. Okay, so we have to split it between these assets over here. So what we will just do, we'll take the 3.5 and split it between our two assets over here. You can split it however you want to. I will just split it as follows. That reallocation, we will split it between the other two assets because the other two assets have no recoverable amount that they gave us. So therefore, we can split it between the other assets. So I'm taking a 3.5 and split it between these assets over here. That divided by the sum. It is something you're going to have to spend time on. It is something you're going to have to spend some time on in order for it to make sense. Ultimately, that reallocation will generally be zero. That reallocation will generally be zero. What did we do? We initially had an impairment of 7.5. Once we did that impairment and we looked at the carrying amount after the impairment, it came to 34. But what did we know? That there's a recoverable amount for this asset, which is 38. The carrying amount after impairment should not be less than the recoverable amount. As a result, because it is less, we had to make an adjustment for the initial impairment. The adjustment that we need to make is to reduce the initial impairment by 3.5, which gives us ultimately an impairment for furniture of 4,000. Now this 3.5 needs to be reallocated amongst other assets that doesn't have the same problem as furniture. As you can see, these other assets doesn't have a recoverable amount. So therefore, that reallocation of 3.5 must be absorbed by the remaining assets. And that is just basically what I did. I took the 3.5 and I absorbed it by the other assets in the same ratio. As you can see what I did. I'm taking a 3.5 and I'm allocating it to equipment based on the weighting of equipment between equipment and machinery. So that is basically how to do the reallocation. In most cases, not always, in most cases, like 90% of the time, 95% of the time, that reallocation will end up being zero. So now what's going to happen? The final impairment will be initial impairment plus reallocation. So as you can see, equipment now is more than the initial impairment. The final impairment for machinery is also more than the initial. But for furniture, the final impairment is less than the initial. This is going to be a typical thing. That's why you want to make use of this table. And now we can go and plug in. So what's going to happen? I'm just going to plug it in over there. And that is basically my journal entry. And as you can see, my journal entry balances. This is the journal entry. Simple. But to get the numbers is not as simple. This is probably like a 15-20 marker question. Let's say between 10 to 15 marks most likely. They could have made it more complicated, which could have taken it up to about 25 marks. The same scenario, just a little bit more complicated, could have taken up to 25, 30 marks, but I would think this is about 10 to 15 marks. So that's all I wanted to cover for today. This is your typical impairment. So make sure you can work through this, understand what we are doing, and then if you have any more questions, you can ask me. But before we end, do you have any questions now that you'd like to ask?
FIS.
Yes.
All right. So the recoverable amount for the furniture were given to be 38,000.
Yes.
So this is not maybe directly to the solution, but just an understanding. So during the initial introduction to that topic, we touched on something where you mentioned that if the recoverable amount
Yes.
should be higher than the.
And the carrying amount.
All right.
Yes.
So if practically, probably just to understand that. So if the recoverable amount was now 30,000 and the value after impairment was 34,000, why would anyone try to then go complicated on the issue now? Why
So,
do you not need to do the reallocation again?
yeah, no,
Already the position has been satisfied.
yeah. So remember that is a bit complicated. This amount over here, this 43,000 over here, is working out a impairment on a CGU level. Okay, so it's working out an impairment on a CGU level, carrying amount of CGU versus recoverable amount of a CGU. So the standard says you'll do this. This is exactly what the standard says you're going to need to do. But the standard acknowledges that because when you although you are working out the impairment amount relative to a CGU, we don't have a count called CGU. So you can't say debit impairment credit CGU. You have to take the impairment to an actual underlying asset. And that is what we are doing over here, right? So the standard is saying, because of that, we will run into a problem where when you do this initial impairment relative to the CGU, the carrying amount of the individual asset after the allocated impairment may be less than the individual asset's recoverable amount. And as a result, the standard says you have to make that check because after allocating the impairment of the CGU to the underlying assets, the carrying amount of the impairment for the underlying asset must not be less than the recoverable amount. So because of that, your impairment calculation is always going to be this complicated because the standard makes it clear. So when you read the standard, if you go to I-36 and you read it under CGUs and how to deal with it, you will come across this aspect that you do impairment on a CGU level. But the impairment must be allocated to individual assets. Then somewhere further it says, ensure that once the impairment has been allocated to the underlying assets. In other words, once you got a carrying amount for the underlying asset of the impairment, make sure it is not less than the recoverable amount. That is why we have this column to check. If it is less, you need to do a reallocation and take it against other assets that can absorb it. If other assets cannot absorb it, so let's say the other assets could not have absorbed it, then our final impairment would have been 43,000 less the 3,560. That is just basically the mechanism of how it works. How they came out with it, I have no clue. But we'll probably have to read the basis of conclusion. But yeah, so if you read the standard, this is basically what they're telling us how it needs to be done. And it's got to do with the fact that the initial impairment calculation is based on a CGU, but when you do the allocation, you don't allocate it to a CGU, but you rather allocate it to the underlying assets of the CGU. And then they say, then the third aspect is once you do the allocation, make sure that the individual asset is not less than the recoverable amount of the individual asset. If it is, fix it. So that is basically what we are doing. So yeah, it is a bit complex, but we're just following the standard. Okay.
Okay, thank you.
So I'll stop here for today. If you guys can work through this and work through that member question we did previously, and then we will you can let me know if you have any questions. We'll probably have the other later this afternoon around 5-ish or so, 5, 6. Is that fine with you guys?
I think we can have it, guys. I think so. Let's have it.
Okay.
Yes, yes, I'm okay.
just to get to up to speed. So effectively, this session is Sunday's session. This afternoon session, later this afternoon, is yesterday's missed session. Okay, then we must all catch up. The other one, which I'll do it in the week with you. I'll tell you when we'll do. Maybe we'll also do again next week, one double session, one weekend. So then by the end of next week, Sunday, we have our 4 sessions intact. Okay. So later we'll do Mambo. We're going to continue Mambo. We're going to do the capital budgeting aspect of Mambo. Okay. So you can maybe just revisit that scenario for later on, and then so you refreshed on it. Okay. Okay. Thank you, guys. I'll see you guys later on.
Thank you.
Okay,
Can you kindly share the Excel on WhatsApp?
Okay,
yeah,
thanks.
I'll share it now. Okay.
Thank you.
Okay. Bye-bye.
Thank you.